Welcome back to the deep dive. Sometimes it feels like the world is just spinning faster and faster. We get hit with everything, right? Groundbreaking tech, shifting economic tides. It's a lot all at once. Easy to feel overwhelmed. But that's why we're here. Our mission today, cut through that noise, connect the dots on some really fascinating stories, and hopefully unearth those crucial insights that help you feel more informed, more ready for whatever's next. Think of it as your shortcut, maybe, to understanding this really dynamic world.
Indeed. And we're seeing this remarkable interplay right now, between policy, innovation, market sentiment. Our sources today, they're a real mix, a rich tapestry, you could say, covering everything from the Fed's next moves, future of AI translation, all the way to corporate shakeups, global trade skirmishes. We'll explore how these, well, seemingly disparate threads are weaving together, shaping our present and definitely our future.
Exactly. From like this surprising market rally, maybe fueled by Fed cuts, to universal translators that feel like they're jumping right out of science fiction. And even a luxury watch, taking a literal swipe at tariffs.
Let's jump in. Okay, let's try and unpack this first one. If you've been following the news, you might have noticed this. Paradox. Markets are hitting record highs. But we've also seen some pretty unsettling economic developments, haven't we? We're talking revisions showing, nearly 1 million fewer jobs created than we thought, a spike in layoffs, inflation creeping higher, especially in tariff-sensitive areas like groceries, furniture. So what gives? Why all the investor optimism?
Yeah, what's fascinating here is how the market seems to be looking past these immediate headwinds. Investors are increasingly forward-looking. They're pricing in a blend of things, policy accommodation maybe, improving productivity dynamics, potential fiscal support. The focus is shifting. It's moving towards healthy corporate profits and this anticipation of relief from Washington, particularly on interest rates. And that's a huge piece of the puzzle, the Federal Reserve, right? Markets are strongly anticipating the first interest rate cut since, December 2024. Maybe even next week. At the FOMC meeting, we're seeing like a 90% probability priced in for a quarter-point cut, some even eyeing a half-point. And traders, they're projecting, 3 cuts for the rest of 2025, 3 more in 26? That would make borrowing cheaper.
Definitely. And this raises that important question, the one people keep asking about that massive amount of cash parked in money market funds. We're talking roughly $7.6 trillion, according to Crane data. But the theory, the wall of cash idea, that it'll just flood into stocks when rates drop, that's been debunked really many times.
Yeah.
Experts like Peter Crane from Crane Data, Shelley Antoni-Vish from ICI, they highlight that a big chunk of this is institutional money or emergency funds. It's, quote, not going anywhere. It's not going into the stock market.
The rates matter, sure, but maybe less than people think for these funds. They'd need to be near zero for a huge shift. Okay, so what does this all mean for you, the listener? If money market rates become less attractive, what are the options? If you're looking for alternatives to just parking cash.
Well, technical strategist Todd Sohn offers some interesting thoughts here. He suggests maybe considering moving out on the treasury curve, so using treasury ETFs, think investing in government bonds, but slightly longer durations, maybe 2 to 5 years, to lock in potentially better yields. Another option he mentions, bond ladder ETFs. These basically diversify your bond investments across different maturity dates, help smooth out returns, manage interest rate risk, that kind of thing. He also advises, and this is key, assessing your equity portfolio for holes. Things like small cap, mid cap, international exposures.
Right.
Because the current rally, it's really propelled by a few huge tech stocks, so diversification is crucial.
Right, looking beyond the headlines.
Exactly. And if we connect this to the bigger picture, we also saw the European Central Bank hold its key rate steady this week at 2%. That's after they already cut it from 3% earlier in 2025. So you see a divergence globally. And here at home, policy-wise, there's this significant search underway for the next Fed chair. Candidates like BlackRock's Rick Ryder interviewing. It underscores this broader desire, maybe not just for new leadership, but potentially fundamental changes in how the Fed operates, given how complex things are.
So while traditional finance is grappling with all this, tech isn't waiting around, is it? In fact, one of those big sci-fi dreams seems to be getting really close to reality, the universal translator. We've dreamed about it for decades. How close are we really getting thanks to AI?
Oh, it's moving incredibly fast. We're seeing the major tech players capitalizing on this big time. Apple's new AirPods Pro 3, unveiled this week, on sale next week. They feature live translation, French, German, Portuguese, Spanish into English, instantly. Imagine that. Google's Pixel 10 phone offers voice translate during calls. It even preserves the speaker's voice inflections, which is pretty amazing. And Meta's Ray-Ban glasses, OpenAI's ChatGPT voice assistant, they also have real-time translation. It's definitely a game changer for travelers. Global communication.
It sounds incredible, really promising.
Yeah.
But if AI gets this good, what does it mean for people? For industries like professional translation, I saw a Microsoft research study suggesting, 98% of translators' work overlaps with what AI can do now?
It certainly raises huge questions, about the future of that industry. And while these big tech offerings are exciting, you have companies like Pocket Talk from Japan, Vasco Electronics from Poland. They make purpose-built translation devices, and they argue their focus on accuracy, linguistics, broader language support. Pocket Talk offers 95 languages, right? Compare that to Apple's 5. They say their tech provides better translations for critical uses, schools, hospitals, places where nuance is vital. And Apple's live translation, it isn't even available for EU users right now. So it shows innovation is powerful, yes, but it still has different applications, limitations. AI might handle the bulk, but maybe high-stakes stuff still needs specialized tools. Or humans.
And speaking to Apple,
Yeah.
while they're pushing communication tech, they hit a snag with another new device, didn't they? Their new iPhone Air.
Yeah.
Super thin. 5.6 millimeters. First major redesign since 2017. But the China launch just got postponed. What's the holdup there?
It's a classic regulatory hurdle, really. The iPhone Air is eSIM only. No physical SIM card slot. But wireless carriers in China need special government approval to sell devices with an eSIM. Tim Cook, Apple's CEO, noted that the eSIM design is actually what allows the great battery life, because the battery extends into that space. So it just shows even the slickest, most innovative products can face delays. External factors, bureaucracy, that complex dance between innovation and global markets.
Right. But while Apple faces those hurdles, there's another company, a much older one, that's becoming kind of indispensable, both inside Apple's world and tech generally. Let's talk about Corning, making waves from deep in the data centers.
Corning, a 174-year-old glass maker. It's proving to be this surprising powerhouse and a great example of those, unseen components that power everything, the picks and shovels of tech. They make specialized cabling that supports NVIDIA's AI chips, crucial for powering those massive data centers driving the AI boom. Plus, they have that deepened partnership with Apple, making the tough glass for iPhones, Apple Watches. Apple's actually investing $2.5 billion into projects with Corning. Plans for a factory dedicated just to the newest Apple phones. And it's paying off for Corning. Shares are up 60% year-to-date. That's way better than the S&P 500's 12%, NVIDIA's 32%, even Apple's negative 7%. A powerful reminder, right? Sometimes the quiet suppliers are the big winners.
Okay, so from tech innovation, let's pivot. Some major corporate challenges now. Starting with Boeing, the FAA just proposed a $3.1 million fine against them. What were the safety violations they found? What does this really signify?
Well, the FAA found hundreds of quality system violations, both at Boeing's 737 factory in Washington and at their subcontractor, Spirit AeroSystems, in Kansas. This included things like presenting 2 unairworthy aircraft for certification, and even a Boeing employee pressuring another worker to sign off on a 737 MX even though it didn't meet standards. And this is directly tied, as you might guess, to that January 2024 Alaska Airlines incident, the MAX 9 mid-air emergency, where Boeing, crucially, failed to install 4 key bolts on that door plug. So this fine, it's not just about the money, it's a stark indicator of some deep problems. Manufacturing, quality control. It erodes trust, has real safety implications.
And on top of that, they're facing labor issues too, aren't they?
Yeah.
Striking defense workers in Missouri just rejected their latest contract offer, even though it included pretty big wage growth, like 45% average.
That's right. Bringing average wages from $75,000 up to $109,000. A substantial offer on paper. But the union, the International Association of Machinists and Aerospace Workers, said the offer lacked sufficient signing bonuses or a raise in 401k benefits. This isn't just typical negotiation. It really highlights that tension, doesn't it? Even with big wage hikes, workers today are focused on long-term security. Benefits like 401ks matter a lot. It forces companies like Boeing to rethink their whole compensation approach. It's not just about the paycheck. And Boeing is saying they're hiring replacement workers now to meet demand for F-15s, missile systems.
Yeah.
Shows the ongoing pressure.
Okay, let's switch gears again. Auto industry. Ram, Stellantis' truck brand, they just canceled plans for their full-size, all-electric pickup. Why the U-turn? That seemed like a big push.
Yeah, they cited slowing demand for full-size battery electric trucks in North America. That was the official reason. And they'd already delayed the truck twice, remember? So instead, they're launching an extended-range electric truck next year. It'll have an electric generator and a gas engine. They're renaming it the Ram 1500 REV. This move, plus you have the Trump administration unwinding some EV initiatives, canceling some tax credits, it reflects this broader reevaluation of EV adoption rates. It suggests the market, especially for big electric trucks, maybe isn't quite as strong as manufacturers hoped, forcing a shift to hybrids, maybe.
Interesting. Now, a topic touching many people's lives. New obesity pills. Eli Lilly and Novo Nordisk are getting ready to launch oral weight loss drugs next year. How will these compare? The pills versus the injectables.
It's shaping up to be a major battleground. Huge market potential. Lilly expects results soon from a head-to-head trial. Their pill, orforglipron, versus Novo's oral semaglutide. Right now, orforglipron has shown about 12% weight loss in trials. Oral semaglutide, about 17%. For comparison, Lilly's injectable, Zepbound. That's seen as the gold standard currently, helping people lose over 20% body weight. But Wall Street analysts, they predict these oral drugs will capture maybe 20% of the total GLP-1 market by 2030. That market could be $80 billion and is driven by patient demand for convenience. Taking a pill is easier than injections for many.
Are there other differences besides just the weight loss percentage? Things that could sway the market?
Absolutely. Lilly's chief scientific officer points out that their pill, or orforglipron, is a small molecule drug. That makes manufacturing easier than peptides, which is what Novo's is based on. Scalability matters. And, crucially, Lilly's pill has no food and water restrictions. Novo's pill does. You have to take it under specific conditions, those practical factors. Ease of manufacturing, patient adherence, they could play a huge role in market share, especially for a daily medication. It's not just efficacy, it's patient experience, logistics.
Right. Okay, finally in this section, real estate, Open Door, the online real estate platform. They're going through a pretty dramatic restructuring. The new chairman, co-founder Keith Rabois, is not holding back.
No, he is not. He's publicly called the company bloated, stated they don't need more than 200 of their 1,400 employees. That implies, what, an 85% workforce cut?
Yeah.
Massive. And Rabois attributes this to a broken culture, the impact of remote work, and, quote, their DEI path. The new CEO is set to prioritize in-person work. Look, Open Door's radical restructuring. It isn't just about cutting costs at one company. It feels like a potent symbol, doesn't it, of a broader reckoning in tech, questioning pandemic-era growth, remote work effectiveness, even corporate culture roles.
Right.
It makes you wonder, how many other bloated tech companies might be facing a similar, maybe painful reset?
Wow. Okay, let's talk policy ripples now. Something impacting everything from furniture to, well, watches. Tariffs. The luxury furniture retailer RH just reported a big hit, $30 million to its forecast because of tariffs. And they're bracing for more uncertainty. President Trump threatening new furniture duties, trying to bring manufacturing back home.
Yeah, it highlights that direct, immediate impact trade policy has on businesses and ultimately on consumers, Prices go up. But on the flip side, we're seeing some creative, even provocative responses, like the Swiss watchmaker Swatch. They just launched a special edition watch, What If Tariffs? It features the numbers 3 and 9 switched on the watch face, a direct jab, right? At Trump's 39% tariffs on Swiss imports last month, Swatch calls it a positive provocation, hoping to encourage a better trade deal. It's fascinating, isn't it? Brands using products to make a political statement against economic pressures.
Definitely a statement. Okay, from trade skirmishes to the Wild West of finance, maybe. Crypto keeps pushing into the mainstream. Gemini, the exchange founded by the Winklevoss brothers, just debuted on NASDAQ.
Indeed. Gemini Space Station, the entity, rallied 14% on its debut, raised $425 million, valuing the company at $3.3 billion, and the Winklevoss twins, still incredibly bullish, predicting Bitcoin hits $1 million in 10 years, calling it gold 2.0. Meanwhile, Tether, the issuer of the biggest stablecoin, they're making a strategic entry into the U.S. market, launching a new USI token for institutions using the Genius Act framework. And they appointed Bo Hines, former head of the White House Crypto Advisory Group, as CEO of Tether U.S. That signals a clear commitment to engaging with regulators, expanding the U.S. dollar's influence digitally. These moves show crypto assets gaining acceptance, integrating into traditional finance, even as regulation debates swirl.
You mentioned real estate earlier. It seems high net worth investors are finding new ways into the commercial market, even in tricky sectors.
That's where multifamily offices come in. These are private firms managing finances for multiple wealthy families. Travis King, CEO of Realm, explains these families are pooling resources, getting access to bigger commercial real estate deals. And what's really interesting is their focus, the office sector, which many people think is, well, struggling. They believe it's bottomed out. They see some properties as intrinsically cheap, maybe 15% of what it would cost to build new. And they're strategically avoiding crowded markets like data centers, focusing on the lower middle market deals under $50 million, less competition there. King emphasizes, unsurprisingly, that lower interest rates would help real estate in most every regard, boosting transactions, property values. It's a contrarian bet, really, on a sector many wrote off, looking for long-term value where others just see risk.
Okay, finally, we have to touch on this sensitive, politically charged report about public health. The Washington Post reported that Trump administration health officials are planning to link COVID vaccines to the deaths of 25 children.
Yes, the report states this claim is based on information from VA-AIR, the Vaccine Adverse Event Reporting System. And it's crucial to understand VA-AIR's collects unverified reports. Anyone can submit one. It takes scientists, public health officials, doing thorough investigation to determine if a vaccine actually caused a side effect. Right now, there is no evidence that the COVID vaccines currently in use cause pediatric deaths. Global surveillance data generally show the benefits outweigh the risks for children. This comes as HHS Secretary Robert F. Kennedy Jr. is working to change U.S. immunization policy. So it really highlights that vital distinction, doesn't it, between self-reported data and scientifically verified conclusions, especially in such a charged public health discussion.
Wow. Okay, so from market paradoxes, AI's linguistic leaps, to corporate retrenchments, those creative tariff battles, it is so clear we're living through an era of really profound transformation.
Absolutely. What stands out, I think, is just the sheer velocity of change and how interconnected it all is. A small regulatory tweak in China impacts a global tech giant. A protest watch symbolizes huge international trade tensions. These stories remind us understanding the why behind the what is just more crucial than ever.
So what does this all mean for you? In a world where, science fiction is basically becoming reality, and economic certainties are constantly being redefined. What old facts are you holding on to? Maybe things that need a deep dive of their own. Something to ponder as you navigate your week.
Keep asking those questions. Keep digging deeper. Keep seeking out those aha moments.
And we'll be here to help you unpack it all next time on The Deep Dive.